Today we're going to talk about why gold is an important asset as part of your overall retirement strategy. And really, it's more of a bond than a stock, right? It's really a defense rather than an offense. But we know sometimes a good defense is a good offense, allowing you to preserve your capital and move into the market with other parts of your portfolio and the rebalancing that I just mentioned in the last video. But we're going to take a look at why gold is a good part of your defensive portfolio to help hedge some stock market risks, to help hedge some inflationary risk due to the debt and being off the gold standard for the last 50 years. We're going to take a look at the inverse relationship that gold has typically had with the Dow Jones. And understanding this will help you understand why it can make sense for a portion of your portfolio. So we're going to look here. This is not very well known by a lot of investors, and I think a lot of people don't understand gold. But it's understanding a little bit of history. The U.S. has had two hyperinflations before. We had the continental dollar and the greenback dollar that were wiped out, and then the founders put us on the gold standard. We were like that for over 200 years. Really until 1971, so we're really only 50 years, give or take, without the gold standard. But as we've seen, the debt is really starting to skyrocket, and it's really meant, some people say, I want to earn more in stocks. It's not really a replacement for your stock, it's more of a replacement for your bonds. But gold has this historical inverse relationship, and I'll walk you through, and can really increase your purchasing power and your ability to flip it into the stock market. So having something that can go up if other assets go down, to then rebalance those assets that are up to move into the assets that are down, can help improve your risk-adjusted return. So for example, in the Great Depression, the ratio went from 18 to 1.68. So it increased around 17 to 18x. So having a little bit of gold would have allowed you to really buy a lot more stocks. Okay, this means is you could have even 100,000 in gold would have been equivalent to around 1.6 million in stocks by the end of the Great Depression. Now here, stocks won. This is stocks winning. This is going down. Is gold winning? So what you have here is 28 to 1. So approximately, you could have had 100,000 in gold, your friend could have had 2.8 million in the Dow, and at this point in time at 1, you could have bought his portfolio with your 100,000 in gold. So another way to look at this is if you had a $2.8 million portfolio, $100,000 in gold would have been equal to your portfolio by the end of the decade. So really understanding that concept, I think, is valuable. And then here, stocks are winning, and then gold is winning from 1999 to 2011, and then the last few years, as the stock market's done very well, gold has been underperforming, but we're starting to see that shift change. We are 11 years without a recession, and the debt continues to skyrocket. We've seen the Fed's bluff be called, and they haven't been able to raise interest rates, and we are starting to see gold begin to lead again. And so if you're looking for a defensive part, trying to create that all-weather portfolio, sometimes, maybe instead of a principal protected annuity, you can create sort of a custom all-weather that won't have a principal guarantee, but if you understand history and you understand the rebalancing benefits, can help provide you with good risk-adjusted returns over your retirement period, the next 10 to 20, 30 years. So understanding that concept of diversifying among really three major asset classes: treasury bonds, physical gold, and stocks, to help you keep a disciplined approach to managing risk. So selling assets, rebalancing as they're high, and buying assets that are low, I think can be very, very valuable and help you navigate the current economic environment for the rest of your retirement. Hope you have a good retirement, and talk to you soon.